What if you had consistently invested just $400 per month into the S&P 500 for the past 10, 20 or 30 years? How much would your investment be worth today? Would you be a millionaire? And what type of returns can you expect from the S&P 500 going forward? In this video, we'll break it all down and see what happens when you stick with a simple, consistent investment strategy through all the market's ups and downs. The results might surprise you. Over the past 3 decades, averaged out, the returns on the S&P 500 have been around 10% per year even while going through market crashes. From the 2008 financial crisis to the massive pandemic crash of 2020, investors had to go through some serious volatility. Yet despite all of those setbacks, the long-term trend, meaning 10 years or more, has always remained upwards, rewarding those who trusted the process of consistently investing regardless of what the market is doing. Now, depending on how many years you invested into the S&P 500, your returns will be different, of course. Let's run through 3 different investment scenarios. Let's say that for scenario 1, you started investing in 2015 with nothing but a commitment to put in $400 per month. By 2025, 10 years later, your investment would be worth just a little over $800,000. You'll notice that in your first 10 years of investing into the S&P 500, the amount of money you make from your monthly contributions outweighs the amount of money you make from interest. But you do notice the interest depicted with the color green on this chart gradually increases as the years go by. So how does this continue in the next 10 years? Let's have a look. In scenario 2, had you started investing in 2005 with nothing but a commitment to put in $400 per month, by 2025 your investment would be worth just a little under $290,000, with the amount of interest earned in the 20 years being $193,000, more than double the amount of money you contributed yourself over the past 20 years. In scenario 3, had you started investing in 1995 with nothing but a commitment to put in $400 per month, by 2025 your investment would be just a little over $831,000. And the interest would be just under $690,000, more than 4 times the amount of money you had contributed monthly over the 30 years. Just showing you the massive growth in your investment that you would have and the power of investing consistently without fail over a long period of time. On a side note, in case you're wondering how long it will take you to get to $1 million with this investment strategy, that number would be 32 years. What's remarkable about all 3 of these scenarios that it didn't require picking individual stocks, timing the market, or making complex investment choices. It simply required consistency and patience within the S&P 500. Even during major market downturns, staying invested and continuing to invest would have allowed you to benefit from all the market recoveries that we have had and benefit from the long-term growth. Had you stopped investing out of fear during rough periods, your final amount in your investment would be far lower, as you wouldn't be taking advantage of the massive growth which usually follows after rough periods. Some people might argue that investing $400 per month or saving $100 per week and investing $400 at the end of the month is completely unrealistic. But let's put these numbers into some perspective. Investing $400 a month or $4,800 per year is less than 10% of the median worker's income in the United States, which is roughly at around $62,000 per year. While I do understand that not everyone can easily set that money aside due to their own personal reasons, saving 10% of your monthly salary is a reasonable and achievable goal for many people out there. Some people may argue that the market could have performed differently, that future returns aren't guaranteed. While that may be true, in order to make money, you have to risk your money, at least in a calculated manner. And the reality is that with small but consistent monthly investments, you could have built a 6-figure portfolio over 2 decades. And if history is any indication, the next 20 years could present similar opportunities for those who stay consistent and patient with the investment. It's easy to look back at the years and see that the S&P 500 returned around 10% per year. But actually, staying invested through all the market crashes and surges is the real challenge that you have to face. Being consistent and patient is the key to achieving success in the markets and to build wealth. Market crashes are not just numbers on a chart. They come with real fear, real losses, uncertainty, and financial stress that test even the most disciplined of investors. The money put into these investments are your life savings, and anything that stands in the way of taking that away from you is a real scary thought. Take the 2008 financial crisis for example. The market fell nearly 40%, wiping out years of gains and shaking confidence in the entire financial system. Banks were failing and people were losing their jobs and homes, and it felt like the economy and your life savings was on the verge of collapse. Many investors who had no hope in the economy anymore sold at the bottom, locking in losses instead of waiting for a recovery that at the time felt far from guaranteed. But the challenges didn't stop there. After the initial recovery after the 2008 financial crisis, the European debt crisis in 2010 to 2012 created fresh market volatility, with fears that countries like Greece and Italy might default on all their debts. And then in 2011, the United saw its first ever credit card downgrade, causing stocks to fall once again. In 2015, oil prices crashed, affecting energy stocks and scaring investors about global growth. And then everyone remembers the pandemic of 2020, one of the sharpest and fastest market drops in history. In just weeks, the market fell nearly 30% as the world's economy shut down and no one knew what was coming next. Each of these events took a knock on investor confidence, making it incredibly difficult to consistently invest confidently. The emotional and financial toll of seeing your portfolio collapse, sometimes dramatically, can push even the seasoned investors to question their investment strategy. The reality is that sticking with an investment plan isn't all about numbers. It's about managing your emotions, resisting the urge to react rashly, and trusting that the market's long-term upward trajectory will overcome even the most market collapses. And trusting that the market's long-term upward trajectory will overcome even the worst market collapses. A lot of people panic when things get bad, selling at the worst possible time, but those who stick it out, continue investing, and ignore the noise ended up seeing strong long-term gains. This is the key to investing, not picking the right stocks or funds, but having the patience, confidence, and consistency to stay in the market even when things look grim. Turning out the noise without a doubt is one of the biggest challenges for investors. Trying not to react emotionally to market news is also difficult. The stock market is consistently influenced by headlines such as economic results like unemployment rates, interest rate changes, geopolitical events, and earnings announcements. Even tragedies from around the world will affect the stock's performances. But reacting impulsively to every piece of news can do more harm than good. Instead of making investment choices based on daily news cycles, getting to the habit of focusing on the bigger picture, like historical trends, and having faith in the US economy to always bounce back from adversaries like it always has. Over the past 20, 50, or 100 years, the market has endured recessions, political turmoils, inflation spikes, and financial crisis. Yet it continued to rise over time. While past performances doesn't guarantee future results, many investors believe that the S&P 500 will still continue delivering strong long-term returns in the coming decades. Of course, you cannot assume that future returns will perfectly match historical averages, but one thing is for certain: we will continue to experience regular market volatility. Historically, the S&P 500 has trended upwards since it was created in 1957, so timing the market is far more important than trying to time the market. Instead of trying to predict short-term price movements on the S&P 500, you should focus on a dollar cost averaging strategy, which means investing a fixed amount of dollar at regular intervals, which in turn will help smooth out volatility and reduce the risk of making large investments at market peaks. To maximize gains, it's crucial to minimize fees. ETFs that track the S&P 500 like Vanguard's VOO are extremely cheap ways to buy the S&P 500, meaning that their expense ratios are at a minimum. Vanguard's VOO has an expense ratio of just 0.03, which is extremely cheap. My suggestion would be to find an ETF tracking the S&P 500 which your country provides, and firstly ensure that the company is reputable, ensure the expense ratio is low, and automate your investment into this fund. Track the performances of it every 3 months, and the most important thing is to be patient and consistent with the investment and watch your net worth grow. The S&P 500 has never lost money over any 20-year period, making it one of the most reliable and safest way to build long-term wealth. Sure, there are many smaller periods and years that the market has been negative as seen from this image. Most recently, negative 19% in 2022, negative 6% in 2018, negative 1% in 2015, and negative 38% in 2008. But by sticking to a consistent investment plan, avoiding panic selling and reinvesting dividends, investing on a monthly basis and not trying to time the market, you put yourself in the best position to benefit financially from the market's long-term growth. Going forward, ensure that you build on your discipline, patience, and your trust in the process. The next 20 years will have their share of challenges just as the last 20 years did. But those who are prepared to play the long game, the potential for building long-term wealth is there. If you have liked this video, then you will like my next video about the 4 types of people who will always be rich. Like and subscribe for more.